So hey guys, today I want to talk about how we can bring the common sense back to real estate. To me, I've seen the market shift drastically since 2017. I have to say that most of the projects that I was involved in started from 2008 over to 2017. And to get those projects done, I did a little over 172 projects. You really have to be efficient. You really have to understand the asset class that you're buying. And you have to be able to control the different variables within real estate. And when I say variables, I mean the cost, meaning insurance, taxes, maintenance. These costs have to be controlled. And I noticed in 2017 and 18 that these numbers were no longer making sense. I did a 10-unit building, a total gut rehab, and when I was done with this building, the numbers did not make sense. There was nothing there for me to sell to make money. And on the rental side, I noticed that it was gonna take 9, 10, 11, or 12 years to get my money back. And that to me was not a good deal. This is the reason why I pulled out of the market. And for many years, I didn't understand how this market was thriving because I knew the basic things, which was the fundamentals, the basic fundamentals of buying real estate and owning the asset class, which is the cost of operations, how high property taxes were getting, how insurance costs were changing, going up, and how these contractor prices were also going up, labor, and how the cost of materials were going up. So I can see, to me, I didn't have to read a report or get a magazine and read about what was going on in my business. I was an entrepreneur and I was out there daily feeling out these costs, and it was very apparent that it didn't make sense. So in 2020 and 2021, you'd get a listing either in commercial or residential, and there was a bidding war. And it was very sad because the winners of these bidding wars were institutional buyers, Wall Street buyers. They were coming in with a ton of cash, trillions, and they were buying up properties that your everyday American could not buy. And what happened there is that it took some of these properties and it made them 4x and 5x and 6x and 7x and 8x for certain clients, for certain buyers. It took them out of the market completely. So now these institutional buyers are coming in basically controlling the market, controlling pricing. Your average person, myself, I didn't know this was going on, but I knew one thing, that there was no way that I was jumping in because I knew that the numbers made no sense, and that's all I needed to know. And I didn't want to burn my hands by touching it because I knew it was hot and no good. That's what's nice about like being on the ground and understanding what's going on. So politically, on the political side, I didn't know that these institutional buyers were coming in. So now we have the institutional buyers that are raising prices and controlling and manipulating our market, right? And now these prices triple, quadruple, and your average person doesn't understand that the same thing is going to happen with the tax bill now. It takes a while for it to get reassessed, but it's going to reassess in residential, in commercial, doesn't matter what asset class. Condominiums, does not matter. If you bought it and you bought it for 2x or 3x of the seller's original purchase price, you're gonna see a hike in your tax bill. You're also gonna see a hike in your insurance bill. And along with these hikes, you're gonna see a hike with your HOA bill. And in commercial, you're gonna see a hike with your CAM bill. So all these hikes were occurring, but money was really cheap and Wall Street was really running, controlling the pace of the dispositions and acquisitions. And when you can control that, when you have the power to control and manipulate this market, your everyday person does not know what's going on. So now let me give you an example. You got Blackstone or BlackRock, you have to look it up. Wall Street institution is liquidating 28,000 homes. okay, at a loss. I live in Wesley Chapel, and I'll give you a small example. They purchased a home in Wesley Chapel, Blackstone, for $490,000 in 2021. And this home, they thought that it was going to be able to be supported by a high rental, by them renting it at a higher price to support the ridiculous purchase price. So Blackstone bought the property, closed on it, put it up for rental, and it didn't rent. Over 2 to 3 years, the property did not rent. So that property today just sold for $360,000. They took a $130,000 bath on it, and they're liquidating 28,000 homes across America. What does that mean for you? Okay, is if you bought in 2021 and 2022 and 2023 at the peak, it's really going to hurt your comps. It's going to really hurt the value of your homes. In commercial or residential, it's going to hurt your value. Okay, so that's what that means for you. What does that mean for the younger Americans? Is that you're going to see prices drop because Blackstone is liquidating 28,000 homes at a loss. They're going to be the new comparable. When the appraiser goes to do an appraisal, they're going to use those low comparables, and they're not going to approve and appraise these high valued prices that sellers today want to sell for. And I understand the sellers, but let me tell you something. It's your problem. You overpaid for the property. It doesn't mean that the next person that's going to come in to buy has to pay you what you paid or has to pay you more than that you paid. You put yourself in a pinch, you put yourself in a corner. It's unfortunate. I feel terrible for you, but you're going to have to either give the keys back to the bank, or you're going to have to go on the market and take a big check to the closing to offset the deficiency between what you owe and what you sold for and what you're going to pay the bank. So just understand that there's a couple different things going on in the market that are a bit strange. Another thing to highlight is that the executive, David Ald, and Barbara, that is also an executive with D.R. Horton, just liquidated their stock. So David liquidated $3.9 million of his stock, and Barbara liquidated about $900,000 of their stock, okay? And they're not allowing any insider trading. And what that means is that no one within the company, employees, are interested in even buying these stocks, okay? So right now, they're liquidating these stocks. If you look at these builders' stock prices, they're tumbling, they're crashing, okay? And what that means is we're in trouble, guys. They're in trouble, okay? They're building these houses. They're not telling you, but they're spending anywhere between 15 and 50 grand on buying down the interest rates so they can compete and they can continue to sell these properties that make no sense. But this is the only way they can liquidate these properties. And that song and dance is going to also come to an end. There's these different variables that are going on that you have to be aware of and you have to be ready for, because all it means for anyone that has money in the bank or anyone that has equity or anyone that's even bought a house cash, and let's say you lose half your value on your house, but you bought it for cash, you could still pull a line of credit on it and you could still take advantage of what's about to come, which is a huge cut in price, okay? Huge. So let's talk about commercial now. Let's talk about higher end asset classes, okay? And this is what data is showing. This is not what I'm saying, but this is what data is showing. Let's talk about a high rise in Chicago. High rise, and there's a ton of them. There's a ton of these deals going on right now. There's a ton of these asset classes in trouble, but let's just talk about this one specific one. This building's in Chicago. It's one of the high rises. It had a 230 or 40 or 50 or $60 million note. It's right in there, right? And it just sold for $70 million. Huge loss, guys. There was another property that Walmart just bought for $31 million that had a note for $220 million, okay? When I jump on and I look at the Tampa market, what's going on in the Tampa market, I've noticed that there's a little over 900 mortgages in commercial in Tampa, and 247 are on the watch list, meaning they're possibly gonna be in foreclosure for non-payment or in foreclosure for high vacancy. or in foreclosure because the note is about to set. And what's difficult about commercial is that you get either a 2-year loan, a 5-year loan, a 7-year loan. If you're lucky, you get 10 years, okay? But they're really not giving out 10-year loans. So we got about $1.5 trillion that are gonna come due within the next 12 to 16 months. And what that means for these commercial owners is that their payments are about to almost triple. And I'm not the only one saying it, and it's true. You'll hear it out there on different podcasts, and it's true. Because the data that I'm looking at, which is I can see people's notes, people's loans. I can see when they bought it, what they bought it for. I can see when their note's gonna mature, meaning when's their mortgage going to mature. And it's gonna start in March, April, May, it's starting. And then I can see the new appraised value that's coming in from the banks and why these properties get put on the watch list. And it's incredible what I'm watching. I'm noticing properties that sold for 280 million with a new appraisal of 110 million, 240 million with a new appraisal of 80 million. It's a huge drop, guys. We're starting to see 60, 70, 80% drops in commercial. And this is just the beginning of it, okay? Your average person really does not understand what's going on. It's just the beginning of it. You're gonna have to sit back, strap a seatbelt on and enjoy the ride, because it's gonna be one hell of a fucking ride when you see what waters we're about to enter. But it's an opportunity. Don't look at it as a bad thing. And if you're in it and you're one of those investors that are leveraged, right, then you have to figure out how to pivot and make it positive for you, okay? Let's talk about this 20-unit building that I just finished calling on. This building, I love talking to the young kid. It was an agent from Marcus Millichap, a young kid in his early 20s. And I called on a 20-unit building that was built in 2022. And the reason that I called on it is in the description of the building, he typed in there that this building, we could increase the NOI, net operating income, by 45%. That's what it read. Building looked really nice. Photos look really nice. And it's a new building built in 2022. So it made me want to call and find out what's going on with this building. So I got on the phone with the realtor, young kid, and he was very detailed. He goes, hey, listen, this is what's going on with this deal. My buyer bought it for 3.5 mil, had an appraisal on it, 4.7 mil once the property was fully occupied. So the client bought it from the developer, vacant, with an appraisal stating that once they occupy it, it'd be worth 4.7, 4.8, 4.9 mil, right in there, okay? So the buyers went ahead and closed the deal. They had zero experience. They were never in the multifamily business, but the market is hot and everyone's jumping in with experience or no experience, okay? So listen up, this is what happens. So this buyer jumped in, zero experience. He's getting, or she's getting, killed on the maintenance costs right now. They're getting killed on the operations costs right now. They're getting killed on the occupancies of the building at the moment because it's not fully occupied. They're getting killed with low rents because they're not even capable of renting the building at market rents. So now the seller's position right now at the moment is he's willing to give the keys and the building back to the bank. So then I went one step deeper with the young man that I was on the phone with, and I was like, hey, listen, have you talked to the bank? Do you think we can make an offer to the bank? I don't want to pay anywhere near what they owe. And he says, at the bank right now, we have talked to them. They're not too sure exactly what they want to do with this asset, but they do know that there is some trouble, and they know that they're possibly going to end up with this property. I was like, okay, cool. So, hey, kid, a question for you. How did you do last year? What's going on? How was the market last year for you, or even this year? He goes, Jose, I got to say that the market this year so far has been decent. We've listed about 10 properties in the last 30 days. But I also have to say, it's going to be very difficult to sell these listings. And this is where you know when you're talking to a professional. He's a young kid. When the Great Depression happened in 2007 and 8, I'm sure he was 2 years old, if that. But he's well educated. He's got his foot on the ground. He's educated. He's not selling me a pipe dream. He didn't know I was a realtor. He didn't know that in my experience. He was just talking to a regular human being on the phone. And I knew immediately that I was talking to one of the real ones, because it's very difficult to find real realtors They keep it transparent and tell you exactly what's going on. And that's what you want to find. So guess what? His number got locked into my phone, and he's one of the kids that I would be, touching base with, because he's going to be transparent every time I call him, and we're going to get live data on what's going on the market. And these kids are the ones that are going to give you information better than an economist, because they're working 12, 13, 14-hour days on that phone, taking care of business, figuring out what's going on, talking to banks, talking to bankruptcy attorneys, talking to sellers that are desperate. They're on it. They know, okay? And they'll have a 13, 14, 15, 16 months of information before you even see it on the news. So this is why it makes me excited when I meet one of these young kids that really understand what's going on in the market. If you have an asset right now that is troubled and you need help selling, exiting, or being put with a bankruptcy attorney to help you with your mortgage or anything of that sort, you can go ahead and reach out to me at josejuarbe.com. Or you can DM me on Instagram, which is Cap Rate Group. Please follow me on LinkedIn. I need you to smash the subscribe button if you like the information that I gave you. This is just to educate you and give you really good intel for the future. And again, I just want to bring common sense back to real estate.